If you kept $10,000 in cash for the last 10 years, inflation already cost you over $4,000, and you never even spent a cent of it. You did not make a bad investment. You did not lose your job. You simply held on to your money, and it still lost value, quietly, invisibly, every single year. Today, in the next 15 minutes, I am going to show you exactly how that happens, why most people never see it coming, and the specific steps that protect your money from being silently stolen for the rest of your financial life. Stay with me, because the number in the middle of this video is the one that changes everything. Welcome to Money Explained in Minutes, where complicated money becomes simple truth in under 15 minutes. By the end of today, you will understand exactly what inflation is, exactly what it does to your savings and your salary, and you will have a clear action plan to protect your money starting this week. Let us get into it. Let us start with what inflation actually is, because most people have a rough idea, but not a precise one. And the precise understanding is what changes how you act. Inflation is the rate at which the general price of goods and services rises over time. When inflation is 3% per year, something that costs $100 today will cost $103 next year. That does not sound dramatic, but here is what that actually means for your money. If your money is sitting in a jar or even in a savings account earning less than the inflation rate, it is losing purchasing power every single day. Not because the number changes. The number stays the same. $10,000 in January is still $10,000 in December, but what that $10,000 can actually buy has quietly shrunk. This is the core mechanism of inflation, and it works whether you are paying attention or not. Here is a real example that makes this impossible to ignore. In 2015, $100 bought a full week of groceries for a typical household. By 2025, that same $100 bought roughly $60 to $65 worth of groceries at 2015 prices. The money did not move, the number did not change, but a third of its value quietly disappeared. That is not a crash, that is not a headline, that is just inflation doing what it always does. Now, let us talk about the most common mistake people make with inflation: holding cash and thinking it is safe. Cash feels safe. It does not fluctuate. You can see it. You can count it. But safety and stability are not the same thing. Your $10,000 is stable, but it is not safe from inflation. Every year inflation runs higher than your savings interest rate. You are losing money, guaranteed, automatically, silently. Let us run the exact numbers. $10,000 held in cash over 10 years, with average inflation of around 3.5% per year, loses approximately 30% of its purchasing power. That is $3,000 gone, not spent. Not invested badly, just gone, because inflation ran faster than your money grew. And if your savings account earned 1% while inflation ran at 3.5%, you were losing 2.5% every single year and calling it safe. This is what I call the safe money illusion. The number in your account stays the same or grows slightly, but the real value, what that number can actually buy, erodes every year. Most people look at their savings account, see the balance growing, and think they are making progress. They are not accounting for what that balance actually buys, and the gap between the number and the reality widens every single year. Inflation runs. The longer you hold cash above the rate inflation is running, the larger the gap becomes. This is compounding working against you. The same mathematical force that builds extraordinary wealth over time, when pointed in the wrong direction, with cash sitting idle, quietly destroys it. Compound interest works for you or against you. Holding cash during inflation puts it firmly in the against column. Now let us talk about the part of inflation that hits people the hardest, but is talked about the least. what it does to your salary. Most people think about inflation in terms of prices going up. Fewer people think about what it means when their salary stays flat or even grows slightly, while inflation runs above that growth. If you got a 2% raise this year and inflation ran at 4%, your salary effectively went down by 2%. You are earning more. You are buying less. This is called a real wage decline, and it happens silently. Nobody sends you a letter saying your salary just went down in real terms. Your pay slip still shows the same number or a slightly higher one, but your rent costs more, your groceries cost more, your energy bills cost more, and your actual standard of living quietly falls even though the number on your pay slip went up. This is one of the most financially damaging things inflation does, and it is almost invisible because nobody frames it this way. Here is the data that makes this real. Between 2020 and 2025, average wages in most developed economies rose by around 15 to 20%. Average inflation over the same period ran at roughly 20 to 25%. Which means the average worker in most developed economies saw their real purchasing power decline over a 5-year period. Even while their nominal salary increased, they were earning more and getting poorer at the same time. There is a fourth dimension of inflation that almost nobody talks about, and it is arguably the most insidious. It is called the inflation tax, or sometimes bracket creep. Here is how it works. As inflation rises, your nominal salary rises to keep pace, even if your real salary is not actually going up. But because you are earning more in nominal terms, you may cross into a higher tax bracket, which means you are now paying more tax on a salary that has not actually increased in real terms. You are being taxed on inflation, not on real wealth creation. Beyond bracket creep, inflation taxes your savings in a second way through interest taxation. If your savings account earns 3% interest, but inflation runs at 4%, you are already losing in real terms. But on top of that, in most countries, you pay income tax on the 3% interest you earned, even though that interest did not actually represent real growth. You are paying tax on a return that did not even keep pace with inflation. The government taxes the number, not the reality. So, what does protect you from inflation? There are 5 asset classes that have historically maintained or grown purchasing power during inflationary periods. Understanding why each one works gives you the tools to build a portfolio that inflation cannot quietly destroy. The first is equities. Ownership in businesses. When prices rise, companies generally raise their prices too, which means revenues and profits can keep pace with or beat inflation over time. The stock market over long periods has outperformed inflation significantly. The second is real estate. Property that generates rental income. As inflation rises, rents tend to rise with it, and the asset itself often appreciates. The third is inflation-linked bonds, government bonds specifically designed to adjust their return to match the inflation rate, so your real return is protected. The fourth is commodities, physical assets like gold, oil, and agricultural goods whose prices tend to move with inflation. The fifth, and arguably the most accessible, is index funds, which give broad exposure to the equity market without requiring individual stock picking. None of these are a guaranteed shield. Every asset has risk. But the key principle is this: holding cash during sustained inflation is the one guaranteed way to lose purchasing power. Every other asset class at least has the potential to keep pace. Cash does not. This is not an argument to take reckless risk. It is an argument to understand that doing nothing with your money is itself a decision, and during inflation, it is the most expensive decision you can make. Before we get to the action plan, there are 3 things that make inflation significantly worse for your personal finances, and understanding them helps you avoid making the decisions that turn a manageable situation into a damaging one. The first is holding too much cash relative to your investment exposure. We have covered this, but the number most financial planners suggest for emergency cash is 3 to 6 months of expenses, not 3 to 6 years. Everything beyond your emergency fund held in low-interest cash is actively losing your money every year. The second is consumer debt, with fixed high interest rates. When inflation rises, central banks typically raise interest rates to slow it down. If you are carrying variable rate debt, credit cards, variable mortgages, personal loans, your interest payments rise as rates rise. You are being hit twice. Inflation eroding your purchasing power and rising interest rates increasing your debt costs simultaneously. The third is panic buying inflation hedges at the peak. When inflation becomes headline news, when everyone is talking about gold and commodities and property, prices for those assets are often already inflated. Buying a hedge after the inflation peak has been reached is one of the most common ways people lock in losses at exactly the wrong moment. The time to build inflation protection is when you are not in a crisis, not during one. Here is your 5-step inflation protection plan. This week, 0 cost. Works at any income level in any country. Step 1. Calculate your real return on your current savings. Take the interest rate your savings account pays. Subtract the current inflation rate in your country. If the number is negative, which it likely is, you are losing money in real terms right now. Name that number. Write it down. You cannot fix what you cannot see. Step 2. Make sure your emergency fund is correctly sized and not oversized. 3 to 6 months of essential expenses, not more. Anything above that threshold sitting in low-interest cash is paying an inflation tax every year. Move it somewhere that can at least partially keep pace. Step 3. Begin or increase your investment into broad market index funds. You do not need to pick stocks. You do not need to understand every company. A simple, low-cost index fund tracking the broad market has historically outperformed inflation over every rolling 20-year period since modern markets began. Set up an automatic monthly contribution, even small amounts. Automate it today. Step 4. If you have variable rate debt, make paying it down a priority. In a rising interest rate environment caused by inflation, your variable debt costs more every time rates rise. Eliminating it removes one of the 2 ways inflation hits you simultaneously. Pay the highest interest rate variable debt first. Automate an extra payment this week. Step 5. Track your real purchasing power, not just your account balance. Once a month, look at your net worth number. Then look at what that number actually buys compared to last year. The number that matters is not how much you have, it is how much your money can do. A real purchasing power check once a month keeps you honest about whether your financial position is genuinely improving or just keeping pace with the numbers. 5 steps, all free, all starting today. Step 1. Calculate your real return. Step 2. Right-size your emergency fund. Step 3. Automate index fund investment. Step 4. Eliminate variable rate debt. Step 5. Track real purchasing power monthly. This is your inflation protection system. Not complicated, not expensive, just clear and consistent, starting this week. Let us bring everything together. Inflation is not a crash. It is not a headline. It is a slow, invisible tax on every dollar you hold that grows at a slower rate than inflation runs. Section 1. What inflation is. The general rise in prices that erodes purchasing power every year automatically. Section 2. How it destroys cash savings. Every year, your savings earn less than inflation. You are guaranteed to lose real value. Section 3. What it does to your salary. A raise below the inflation rate is a real pay cut. Section 4. The hidden tax, bracket creep and interest taxation on returns that did not even keep pace. Section 5. What protects you, equities, real estate, index funds, inflation-linked bonds, and commodities have all historically kept pace. Section 6. What makes it worse? Too much cash, variable debt, and panic-buying hedges at the peak. You now understand something most people never learn about the money they work hard to earn and save. Inflation does not care how disciplined you are. It does not care how careful you are. It taxes the passive, the uninformed, and the complacent, equally and automatically. But now you understand the mechanism. And that understanding changes every decision you will make about where your money sits from this point forward. The moment this video ends, do one thing. Calculate your real return on your savings rate minus inflation rate. Write that number down, because you cannot fix what you cannot see. If this gave you value, subscribe to Money Explained in Minutes. Every week, one important money concept made as simple as possible. No jargon, no lectures, just clarity. Drop a comment below. Has inflation changed how you save or manage your money? I read every single one. Next week, we are going deeper. We are going to look at how interest rates work, why central banks raise them to fight inflation, and what that actually means for your mortgage, your savings, and your investments. Subscribe so you do not miss it. Money Explained in Minutes. Understand money. Build wealth. See you next week.